Eric Muathe, Muathe.com. It is August 20th, 2015. Let's take a look at markets here with about 45 minutes of trading so far. Markets down about 200 points on the Dow, 1%, about 1.4% down on the NASDAQ, and about 1% down on the S&P 500. We are currently off the lows of the day, but let's take a look at the weekly chart here for the NASDAQ, and the line we've been watching on the weekly looks like it could be broken. So that could be a problem, number one. Number two is, depending on how the market responds for the rest of Thursday and going into tomorrow, it looks like for this week we are breaking below 50 on the weekly RSI. As long as the NASDAQ weekly is below 50, having closed above 50 at the end of last week, this would suggest that this is going to be a big down week net. In other words, I don't see any chance of a recovery if the market is trading below 50 on the NASDAQ weekly RSI. We take a look at the NASDAQ daily, and we can see that it needs to hold these two lines that we've been watching here. It needs to defend that line, the green line, and also needs to defend the other RSI lows line like that. And now that it's trading below those two lines, the possibility is there that this could get worse. But then again, if it can just engineer a way to move back above those two lines with uniform activity, then the market should be okay. But the risk is it could get worse. Now keep in mind, if I take a look at the NASDAQ monthly chart, so let's take a look at that. So on the NASDAQ monthly for this month, we are moving below 69.1, and usually when you're moving below 69.1, you get a big down month for the most part. So that's the problem here. Market is now showing the NASDAQ, which was holding above 69.1, trading below that threshold, suggesting this could be net a troublesome month to the downside. Now keep in mind, this is significant because we've been holding above 69.1 going back to about April of 2013. So this is a long time in the making. So now that the market is back below 69.1, the risk, and I've been saying this for a while, is this could get worse. We take a look at the Dow weekly, and for 2015, this is the previous weekly closing low, 17,164, and right now we look like we're trading below that. The more we trade below that 2015 weekly closing low, keep in mind that we have this crossover between the 13-week moving average and the 34-week moving average. I think you put all those things together, and especially if the Dow is trading below 17,164, which is suggesting the lowest close for 2015, this is not good in terms of where the momentum is starting to look, which is down. And when I say down, I mean significantly down, which means if the market is truly going to be looking to go down, expect 500 point down days, or maybe even 800 point down days at some point, even 1,000. It's going to happen. This will become normal because when markets go down, they take the elevator. On the way up, staircase. But for some reason on the way down, they like to choose the elevator. So be aware that if this is truly becoming a bear market, you might not get a chance to get out of your positions, and so you have to make sure that your stops are in place. You want to get stopped out early and wash your hands off the market if this is going to become a bear market. If on the weekly for the Dow, if it can hold this line, that's good. Now as you can see right now, we are looking like we are breaking it, and a break of this line, which has been holding the market for the last 2-3 years, would suggest a significant change in the sentiment, and again pointing to the downside direction, suggesting that this could become a full-blown, full-fledged, fast-moving bear market, very volatile, tough to time, with significant rebounds along the way, but then again they fade. So in other words, it's a very tricky market. For the most part, you're better served probably watching it from the sidelines. We take a look at the Dow daily, and the green line here is where it needed to hold. Right now it looks like it's not holding above that line. Could be a problem. We also see that on the Dow daily RSI lows line. This needs to hold. Those two lines need to hold Otherwise, the more we stay below the two lines, the more we are looking at a significant possibility of lower prices. Now, we definitely do need to take a look at the Dow monthly, and because this is of the major markets, this is the most bearish. And the reason is quite simple, because if you take a look at the Dow MACDs and the RSI, as of right now, draw that correctly. As of right now, we are trading at 3-year lows. And if you're ever looking for a major bear market signal, there it is. So as long as your RSI is making a 3-year low, the suggestion there is that you are entering a bearish phase. The MACD confirms that possibility, because the MACD is also trading at 3-year lows, or at least one of the MACDs. And so there you have the two minimum requirements for a bearish move. And so I have been saying for a while, and I maintain that view, the risk is that this is now a market that is confirming that it wants to go down, and the intention is that it wants to go down. There's a good chance we might not see these highs for a while. As long as this is the look and feel, the MACDs and the RSI at 3-year highs, we're definitely looking at a market that is in trouble. If we take a look now at the S&P 500, which for this week is also pushing its weekly RSI below 50, suggesting that there's a little bit of a little to no chance of a strong bounce. When you're moving below 50, you get a big drop, just like when you moved below 50 during this period here, you had these weekly drops, significant weekly drops. And so that's a risk. And we're already trading well below 50, so I don't see any recovery for this week. Also for the week, we see that for 2015, the previous lowest weekly close for this year is 2076. We are trading below that right now, which suggests that this is also looking to point down. In other words, the 13-week moving average is going to probably do what the Dow has done, which is move its 13-week moving average below the 34, which is another signal that the market might be looking and has an intention of going down in the coming weeks and in the coming months. As far as the S&P 500 monthly is concerned, we can see that if we consider where it is trading right now, in fact, let's take a look at 34 months instead of 36 months, slight adjustment. You can see that the S&P 500 also is not too far off from giving us a major bear market signal, which is right there. This moving to 3-year lows is not a good sign. Absolutely, you gotta respect that. And also this moving to 3-year lows is not a good sign. You have to respect that. You don't know what happens next, but that signal by itself tends to be a very destructive signal. We take a look at the S&P 500 daily, and what we see here is just like the Dow and the NASDAQ, two lines need to hold. Line connecting the previous support line needs to hold there. It's not broken yet, but looks like it is on the way of breaking, or in the process of breaking. And also this RSI lows line, those two lines need to hold. Otherwise, the more we trade below the two lines, watch out, this is going to get worse. And of course, we see that we are trading below the 200-day moving average, which is again putting a little bit of a sour note on some traders. So here the risk is things could get worse. So let's take a look at the VIX, because the VIX has been a good indicator in telling us what the market is going to do short term. So we go to the VIX daily, and on the daily, the line, the number I was watching and I was asking you guys to keep an eye is 15.60, recent daily closing high. As of right now, there's a short-term breakout for the VIX. So as long as it's holding above 15.60, that's breaking out. Now, if you're looking for a reason to be bullish, or at least to consider the market being okay, it is this line here. The reason why I say that is the VIX has been struggling to hold above that line for quite some time. Resistance back below that blue line there, which was off the highs there, the market was a buy. Resistance here, which was sell signal for the VIX, the market was a buy there. And all these points is where the VIX has been struggling. Double top here recently, the VIX struggled, the market was a buy. So it's come back to that line. Depending on how it responds to that line in the next couple of days, if it becomes resistance again, then the market should be okay for a bounce. We take a look at the VIX hourly, and the VIX hourly Those of you who've been with me for a while, you're very aware that this is where the VIX has been struggling on this red line here on the hourly. And I'm using a period of 26 on my RSI setting. And the more the VIX can stay above this red line, the more it has a chance of moving higher. The more it can stay above that red line, the more it can have a chance of recording higher prices. But the problem has been for a while, the VIX has been struggling at this red line. As you can see, as example, short-term resistance for the VIX there, uniform activity above the line and back below it for those highs there. And all these highs on the VIX have come, well, stick there, all these highs have come exactly on that red line. So the more we show resistance on the line, the more the VIX is a sell. But for now, it looks like it's trying its best to break out. So depending on how it trades in the next couple of days, we can determine how further down this market can go. Also on the daily for the VIX, we also have to keep an eye on this line, which has been resistance. If it shows resistance the next couple of days, the market is a buy. But if it trades above that line and trades in this area, then the market should see a little bit of continued pressure to the downside. Let's take a look at the crude oil market by the way of the USO. You can see here that trading below 30.90 on the weekly time frame is the problem here. That's why it continues to make fresh lows on crude oil. And as long as it's trading below 30.90, I've been maintaining that this is going to see lower prices. That's the case. Also on the daily, you can see that the daily continues to trade below 30.90. As long as that's the case, crude oil market should be continuing to trade at least with a bearish tone. So here's a reason why you want to avoid stocks trading below 30.90, and that's why you've seen this most recent slide in crude oil. I would expect lower prices over time. Now, speaking of commodities, take a look at the GLD. And I want to go back to the GLD monthly, just because maybe there's something developing here. We have improving technicals over a couple of months here. In fact, going back to 2013. So this is improving technicals for a number of years while this market has been making lower lows. So maybe gold is starting to stabilize is what I'm thinking here. Maybe the best way of taking a look at this is let's go to the GLD. Let's go about 7 years. So on the GLD, let's go back a little bit further. So about 10 years here. Okay. And so you can see this better. You can see lower prices since 2012, improving technicals throughout that period. And so maybe gold might have a chance of a slight recovery. I'm not sure. But what I can tell you is that right now I'm looking at one stock that seems to be breaking out on the monthly chart. And the only reason why I mention this is because on the monthly, it is doing what it needs to do for potential strong move. You can see here it's just about now moving to 3-year highs, which is what we want on the RSI. And also we see that one of the MACDs is already trading at 3-year highs, which is another minimum requirement being met there. And the other MACD is just now pushing above 0. So I think we can take a look at SSRI just in case there's something developing here. It might work, might not work, but you can use this recent weekly closing high as an entry level there. And the price to watch there is 6.84. As long as it can hold above that, this could be maybe a change in sentiment in gold. Maybe they get a couple weeks, a couple months to the upside. If that's the case, then take a look at SSRI. If it can hold above this recent weekly closing high of 6.84. Otherwise, I'll leave you here with your markets making lows for the day at about 240, 237 on the Dow. You know, if this is truly a bear market, this is going to become a little bit normal, that the markets are going to be seeing big drops day to day, not every day, but on the days they are down, they're going to be seeing relatively huge drops. So could we recover today? Watch the VIX hourly. The VIX hourly should tell you how the markets are responding internally. Eric Muathe, Muathe.com. I'll keep you posted. Good luck, peace, and blessings. Make sure you have your stops in place. This could get worse. You don't want to be caught with bigger losses. If this becomes a bear market, given the monthly charts are showing us the look and feel of a market that could be in trouble. Eric Muathe, good luck, peace and blessings. I'm out. Woo.